If your mortgage rate is over 6.5%, you could be throwing away hundreds of dollars every single month. But here's the problem. Refinancing isn't always a win. So how do you know if it's going to be worth it or if you'll actually lose money in the process? Well, today I'm going to break down the exact math and the timing so that you don't get burned. All right, let's go ahead and get into the meat and potatoes of everything here and look at these numbers with a fine-tooth comb. And we're going to determine when it actually makes sense to refinance your mortgage. So right now up on the screen, I have the calculator up from Mortgage News Daily, and it breaks down everything in a nice, easily digestible format. I'll go ahead and link to this in the show notes in case you want to play around with your own scenario. But with this particular one, we're going to say that the home purchase price was originally $650,000. We did a 20% down payment. We had a loan amount at $520,000. When we got the mortgage, it was 6.99%. In other words, it was right around 7%, which is about the national average 6 to 12 months ago. In fact, many people were above 7%. So we'll just start there for purposes of discussion, and we'll go from there. So we got 30-year fixed, and then over here on the side, it breaks down your principal and interest payment, which you can see is $34.59 per month. And you can see the majority of this payment, what is that, 85% or so, is interest, with about $426 per month going to principal. Now, in this calculator, I'm not going to do it, and I'll explain why, but you can also add the homeowners insurance, and you can add your taxes and any HOAs if applicable, and then it'll show your total monthly payment over here. But the reason I'm not adding this right now is because we're talking about when it makes sense to refi. And I want to be pretty clear on this one, is that any mortgage broker, mortgage banker, loan originator, anybody doing your home loan, they cannot change your taxes and insurance. Even though when they go in there into the system, they can put in slightly different amounts, but it's all based on the information that they're able to get from the county or from your insurance provider. It's not something that they actually are able to impact. The only thing that they can change through a refi is going to be your principal and interest payment, which you see here. So we want to compare apples to apples. We want to know how much are we saving on the principal and interest side of things, and then how much it's going to cost us so we can determine whether or not this makes sense. As a general rule of thumb, very high level overview, you typically want to see like a 0.5% to a full percent reduction in your mortgage rate in order to have a refinance actually make sense. Now, that's going to vary wildly depending on your loan amount and your personal situation. But like I said, it's just kind of a general rule of thumb. It's when you want to start maybe talking to a mortgage broker and investigating whether or not this actually makes sense. So now I'm going to switch over to this other calculator, also from Mortgage News Daily. I'll go ahead and compare, or I'll go ahead and link to this in the show notes rather as well, so that you can do side-by-side comparisons. So we had a $520,000 loan. Original loan is 6.99%. We did a 30-year fixed. We know the monthly payment was $34.59. Now, loan 2, let's say you're able to secure a rate at 5.99% that bring your principal and interest payment to $31.17, which would save you $342 per month. Now, that's not bad at all. So 1% reduction, save you $342 a month. Now it's all going to come down to the cost and then your break-even point, so that you can determine whether or not this actually makes sense. So let me go ahead and pull up a calculator here, and let's just do some rough back of the napkin math, and then we can kind of get into some more granular details here in just a second. But let's say in order to secure that loan at 5.99%, let's say it comes at a 0.5% cost based on your loan amount, plus maybe underwriting of $11.95, and then let's say there's about $1,500 in title and escrow fees. So let's add that up real quick. We have $11.95 in underwriting plus a 0.5% cost based on your loan size. That's roughly about $2,500. I'm just rounding here. And then we had about $1,500 in title and escrow, right? So total cost to secure that rate, or the fees, closing costs, if you will, not including any reoccurring expenses, would come in at $51.95. So this is the true cost to secure that rate. So $51.95, and we're going to save $342 per month. So we'll divide by 342. And that would give you a break-even period of just over 15 months. We'll round down slightly. We'll call it a 15-month break-even. Now, as a general rule of thumb, if you can break even on the expense to refi in under 18 months, you have a win. That is a solid savings. It's a solid benefit, and the cost is not obnoxious to the point where you're like, look, I got to be in this loan for 3-4 years before I even recoup the initial cost to recognize any savings. So that would be what I would actually call, or at least what I personally would consider, a pretty solid deal. Now, before we move on, I want to show you one other scenario where the rate may not be as low, but the break-even cost might be a lot sooner. So let's say instead of 5.99%, we can take a marginally higher interest rate at, let's say, 6.125%. We still save $300 a month as indicated here, but now we no longer have to pay the discount points in order to secure the rate at 5.99. So I'll pull back out the calculator, and let's say we have underwriting at $11.95 plus title and escrow at $1,500, puts your total cost at $26.95. If we divide that by the $300 a month savings, we actually break even in just under 9 months. This case will round up to 9 months. When you're looking at the two options side by side, I think what happens is most people sort of tunnel in and focus specifically on the rate. They're not always looking at the cost versus the savings and the break-even period. So with that in mind, you tell me, what would you consider a better deal? You could take the 5.99%, which is a lower interest rate, save $342 a month, but the break-even period is about 15 months. Or you could break even in 9 months, save $300 per month, and take the rate at 6.125. There's really no wrong answer here. Both of those scenarios are pretty good. I personally would lean more towards the 6.125 and the lower cost with the lower break even, because if we're in an environment where mortgage rates could potentially fall further, then what's to say we can't do this again in 6 to 12 months if the rates are substantially lower and it makes sense. This just allows you to recoup that expense faster and still save a pretty significant amount each month. When it comes to refinancing, we want to look primarily at the break-even cost. So we want to look at our savings, and then we want to look at what it's costing us to actually refinance, and then we can determine what the break-even period is. If, as a general rule of thumb, if it's less than 18 months, that's good. If it's over 18 months, talk to a professional, make an educated decision. I think it'll ultimately depend on how long you plan on staying in the home and what your goals are for the property. The other thing I want to mention is that there are circumstances where it pays to not necessarily take the lowest possible rate with the highest cost. Like the example that I gave, take a slightly higher rate, you have less fees, your break-even period is lower, and in an environment where rates could potentially be coming down and you may need and or want to do this again in the future, that might be a better option. Keep your cost low, get a little savings now, you're taking what the market gives you, and then if you see rates drop and it makes sense again, you can look into it again. Now, are there any situations where it does not make sense to refinance? Glad you asked. Yes, there is. So if you're planning on moving in a couple years, like if you're certain that you're gonna move in a couple years and you won't hit that break-even point in time, does it really make sense to refi? Again, just it's a personal finance is personal. Just make an educated decision, look at the numbers, and determine if that makes sense. The other time it may not make sense is if you're already close to paying your mortgage off, because the rate is not so much the enemy, it's the time in the loan. So if you don't owe very much on the mortgage, the rate is not very relevant. Like for instance, if you owe, $100,000 or less and you're locked in at, 6.5%, what does it matter if you can get down to 5.99%, save a half a point? I mean, it's a savings, but there's, again, cost that comes along with it. And overall, you're not really going to be benefiting much when you look at the cost versus the savings. And so you'd probably be better off just paying that loan off faster, that would allow you to save more interest in the long run as opposed to going through the process of actually refinancing. The other time it doesn't really make sense is if you're only chasing a very tiny rate drop. So if you're going from like, let's say 6.5% to 6.25%, and you're paying like really any fees, and the break-even period, again, it'd be hard not to be over 18 months unless you got a completely cost-free loan, then that may not necessarily make sense either unless the loan amount is very large and you're saving at least a significant amount to make it worth your while. All right, lastly, let's talk about the risks if you decide to wait for rates to go down further, because that is a topic that's coming up a lot as well. I'm waiting for rates to go down further before I lock in the savings. Okay, so for starters, rates could go lower, but they could bounce right back up with inflation or any Fed surprises. In fact, we're kind of seeing that already. The Fed lowered rates, and all of a sudden, Powell came out, started talking. He wasn't quite as dovish as everybody thought he would be, and all of a sudden you saw the 10-year go up and mortgage rates went higher. That same thing happened last year, and I think it is a risk in today's market as well. So if you like it, lock it, get the savings, and then if the market provides another opportunity in the future, then I would look into it again. The other potential risk, depending on the market that you're in, is that if we see values soften. So if you're not in a position where you have a lot of equity today, if you don't have a very strong equity position today and values come down, that could make it more challenging to refinance in the future. When you're discussing this with your realtor or your mortgage broker, take a look at the values and see where you are today. If you have some cushion and wiggle room, you're probably fine. But if it's really tight, it's something to certainly consider. Because if values come down and rates come down, you may be in a position where you don't have enough equity to refi and have a big enough benefit. Or you might be able to refi, but maybe now you have to take on mortgage insurance, and that would increase your payment. No one wants to do that. All right, that is gonna wrap up today's video. I hope that you got some value in it from my extensive rambling. If you did find value in it, I would really greatly appreciate it if you subscribe to the channel, like it, share it with friends, and we'll see you on next week's housing market update. See ya.